If you have clicked on this video, you are probably thinking to start investing your money in 2022, which is awesome, but that is also your first mistake. Why haven't you started yet? If you are in your 20s, then you are at the right place and at the right time. So keep watching. But if you are in your 30s, I seriously want to know, why haven't you started yet? To answer that obvious question straight off the bat, it's never too late to start investing. I guarantee you that someone in this universe will start their investment journey today after watching this video, as I will give you the confidence and the courage you need to start your investment journey. So when it comes to your investment journey, your dreams and your money, start today. But I know that you will say that I don't have a lot of money to start with. But news flash, nobody has a lot of money to start with at the beginning. So if you have very limited money but you still want to invest your money in the entire market, then this video is perfect for you. Let's assume I give you a book of which you have no prior knowledge. So what do you do at the beginning? The most obvious thing is that you will look upon the index of the book, and simply by looking at the index of the book, you will have an idea regarding the content of the book, what the book is all about. Similarly, by looking at the stock market index of country, you will have an idea regarding the entire economical condition of that country. In India, the two most popularly used market indices are Nifty and Sensex. Nifty has the top 50 companies and Sensex has the top 30 companies, and these companies are from different sectors, and in most of the cases these are the market leaders in their sectors. Different countries has different index. For example, the United States has the S&P 500 or the Dow Jones. And remember, there are many other index. Even in India, there is Bank Nifty, which represents the entire banking sector, and so on and so forth. So to start with, I would first want to tell you the concept of index funds, or how the index fund actually works. So indexing is a form of passive fund management. In my previous video, I told you about actively managed mutual funds, where a fund manager actively uses his brain to buy and sell stocks. But in passively managed mutual funds or index funds, the job of the fund manager is simply to mimic or replicate a particular market index. So for example, if a particular stock comprises 1% of a particular index, then the job of the fund manager is to make that stock comprise 1% of his portfolio. The idea of this index fund is that by investing in the market as a whole, we are actually trying to match the returns of the entire market. And since these funds are passively managed, so the expense ratios are very less compared to that of the actively managed mutual funds. Index funds are considered ideal for long-term investment. Our legendary investor Warren Buffet has considered index funds as the best way to invest for the later years of life. Instead of buying a single stock for investment, it makes more sense to buy all the stocks of the S&P 500 at the low cost which is offered by the index funds. For index funds, the goal of the fund is not to beat the market index, but simply to match the performance of the market, in the hope that market always wins and the country will always progress. So summing all this up, we can understand that index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a particular financial market index. Now coming to the pros and cons, or the advantages and disadvantages of index funds. Firstly, the advantages. And the first advantage is that there is lower risk through diversification. As we are investing in a variety of stocks from different sectors, and in most of the cases these are the market leaders in their sector, so the chances that all the sectors will crash at the same time is very less. So the chances of our investments going down is also very less. In other words, we are betting on the growth of the country. Number 2, low expense ratios. Since these are passively managed funds, so the fund manager is not actively using his brain to buy and sell stocks. As a result, the expense ratios of these funds are very less, typically less than 0.1 to 0.2%. But in case of the actively managed funds, the expense ratios are a lot higher, reaching even 1% to 2.5%. Number 3. Strong long-term returns. Advocates argue that most of the passively managed funds are capable of outperforming their actively managed counterparts. Even in the research made in the financial year ending 31st of December 2020, for a period of 5 years, it has been found that 75% of the US large cap funds, which are the actively managed funds, were not able to beat the S&P 500 index, which is a index funds of the United States. And speaking of return, if I open the historic charts of the entire Nifty, we can see that if someone invested 10,000 in the year 2000, then it would have reduced to almost 7,000 by the year 2001. Yes, in just 1 year, there would be about 30% loss. But this is the notional loss. If he gets nervous and withdraws the money, then the notional loss of rupees 3,000 would get converted to actual loss of 3,000. But if he stayed in the game for 21 years, then by the end of 2021, his 10,000 rupees would be converted to a gigantic 1,60,000 at a CAGR of over 15%. And that is terrific. Yes. So, these index funds are ideal for passive long-term investors, as we don't need to actively track the performance of each and every stock. We are betting on the growth of the country, or we are betting in the growth of the entire market. Now coming to the disadvantages. There are very few disadvantages, but to mention a few, the first one is that they are vulnerable to market swings and crashes. Remember, these are also equity linked assets, and as with any equity linked asset, they are always vulnerable to market volatility. So in the short term, there can be some notional loss, but in the long run, rest assured that we will make amazing returns. If you still not believe in my words, I will give you the white paper released by NSE, and as we can see that over a period of 5 years, Nifty 50 has never given a negative return. In fact, over a period of 10 years, it has given an astonishing return of over 15%, 60% of the time. So I feel that this point is a con only if you are investing for a short term. Second, lack of flexibility. Yes, these funds are passively managed, so you cannot actively choose which stocks to buy and which stocks to sell. Yes, so it restricts the flexibility, but you have already understood the benefits of passive investment. And finally, the third point, it is the limited gains. Since the goal of these funds is not to outperform the market but simply match its performance, so indirectly it restricts the growth of the fund. But as I already told, the 75% of the US stocks, or even 75% of large cap or any actively managed funds, were not able to beat the passively managed funds or the index funds. So it makes more sense to invest in an index funds at the low expense ratios. And finally, the most interesting part, can a monthly investment of rupees 500 really amount to a gigantic amount of 35 lakhs? Let's find it out. As I already told that index funds can give a return of around 15%, so investment of just rupees 500 per month over a period of 25 years will amount to 16.5 lakhs, which is good, but it's nowhere close to 35 lakhs. Now see, if I increase the tenure by just 5 years to 30 years, it would become 35 lakhs. Yes, just starting to invest 5 years earlier would make your amount double. Yes, this is the benefit of starting investment early in your life. As I already say that in investments or investing, time has the most value. Your money has no value. So start your investment journey as early as possible. And in my next video, I will do a live investment where you will see that how you can invest just rupees 100 per month. And even that 100 will amount to a really large corpus at the end of like 20 or 30 years. So stay tuned to my channel, and if you like this video, press the like button, subscribe to my channel if you haven't, and I'll see you in the next one. Till then, take care.